One of the questions I consistently get, especially with market volatility, hey, Paul, I know you can't predict the future, but what's going to happen next? Where are our stocks going? What's likely to happen? And it's only natural that people desire that answer. Maybe that they want to invest money, a lump sum, and they're asking themselves, is it a good time to invest? Maybe they're thinking about getting out of stocks altogether. And I'll address that all with an excerpt from a workshop that I've been teaching for well over 20 years. It's about the myths of investing and the truths of investing and how the market really works. And I think that, if you understand some of these tenets, it helps you be a better investor and avoid some of the downfalls and the traps that investors can fall into. If we look through the research, we see that the average investor has gotten really bad returns versus the market. And a lot of them, as a result, don't feel terribly confident about their retirement. And it's because of some of the bad results. Matter of fact, Dalbar actually does this research where they look at the average investor return in asset allocation funds, funds divided between stocks, bonds, and cash. And what they found is that over the last 30 years, they've barely beaten inflation. So no wonder people are a little bit gun shy when it comes to investing. And the reason it comes down to this: they go through this cycle, fear of the future, worried about the future. What's going to happen? Where are things going? What's the government going to do? How's inflation going to play out? So people are looking for a forecast or a prediction, and they look for Wall Street legends that seem to know what's going to happen next. And they look at track record. They have something called a recency bias, where the market's done this recently and they complete it. They think, or an investment manager has had good performance and they think they're going to continue to have good performance. Or if the market is down recently, they complete that pattern as well. Recency bias is very, very normal for people, and understandable as well, because we're looking for patterns. We're used to looking for patterns. And we look at track record, and then we get overloaded with information. Everybody tells us that they're the best. And then what we do is we make emotion-based decisions, like fear and greed, and loyalty and trust tend to drive the ship. And you think about the word emotion. It has a root of motion. It comes from the Latin to move. And you think about it, emotions move us to action. And sometimes it's not the best action. It actually can be very bad for us, and especially when it comes to investing, because we end up breaking the rules. Instead of buying low and selling high, we sell low and then we buy high when we think things are okay again. And we end up with performance losses. We go around and around, we don't have enough money, no peace of mind, and it's no wonder. If we look at the stock market, it goes up and down and up and down, and earnings drive the bus. If the earnings drop, then stocks drop in value. You can see this from this chart. But here's the beauty of stocks. We're talking about owning companies. Companies are run by people, and when earnings go down, they get into high gear and either increase sales by finding different products that they can sell, or if they can't increase sales because the economy is bad, they decrease expenses. They lay off people. And then what happens when they lay off people and they reduce their expenses, then earnings go back up again. So I never worry about stock market downturns. If we look at market downturns historically, what percentage of the downturns have we recovered from? 100% historically. So I don't worry about market downturns. Now, if we look at long periods of time, we see that large U.S. stocks historically on 1955, including the Depression, World War II, and all the bad stuff that happened, we see that the rates of return are consistent over longer periods of time. These are 30-year periods, and we see that they're all in the same range. Now, you may be saying, well, Paul, I don't have 30 years, and we'll talk about that more in just a second. Because we look at that, and some people will say, well, I'm not buying green bananas. I heard somebody in a restaurant yesterday, I'm a little bit nervous, market's doing this. I'm not buying green bananas anymore. And all I could think of is, wow, okay, I would love to jump in on that table to talk a little bit more about investing and the length of downturns historically, how long they last, because I think people would be surprised to find out that historically market downturns just don't last as long as they may think. I have a whole workshop that's called that. I'm too old for this. And we had a lot of viewer interest in that particular topic. So I did a whole thing. It's on the internet still. You can go search for it. Paul Winkler, I'm too old for this, or something like that. So market timing. Market timing is, something that we're really tempted to do. And remember, the definition of market timing is any attempt to alter or change a mix of assets based on a prediction or a forecast about the future. If I'm thinking, oh man, I think the market's going to continue to go down, I'm tempted to pull out of stocks. That's market timing because I'm changing the mix. Or if I think it's going to go up and I change the mix to more stocks, that's market timing as well. And it's both a prediction about the future. And the myth here is that money managers can utilize their skill to do this to effectively predict up and down markets. Well, what we find in the research is that it doesn't work so well, but the media and the financial industry constantly encourages this activity. You look at the funds in different areas of the market, large and small and value and growth and international US, and we see that they just simply don't increase returns as a result of their efforts to stock pick and market time. And then you have this thing called tactical asset allocation. People are like, well, I'm either 100% in stocks or out of cash or vice versa. And that's pure market timing. But typically, Wall Street doesn't practice it that way. They do tactical asset allocation. I think that value stocks are going to do better than growth stocks, or I think it's going to be a good time for international versus US or US versus international, or tech stocks versus energy stocks or something like that. And they move money around. And it is another form of market timing. And we see that funds do consistently engage in this activity, as you can see from these charts right here. But it just doesn't help. And the media doesn't help either. They come out with these things, these predictions, and it's the great American pastime to report on market conditions. What's the Dow doing? The NASDAQ, the S&P 500. And what we do is we try to use this information to try to predict the future. And the media realizes that you do this and you want to do this because it is so competitive. Trying to get your attention is so competitive right now, way more than in history even. And what happens is they come out with more sensational headlines to try to get your attention. This happens now a lot, but it isn't new. If we go back to the 1930s, we see Collier's, don't be a sucker. You got burnt in the market crash in 1929. You're going to rush back into speculation. And they were scaring people out of the stock market. Well, what happened? They were showing us that Hoovervilles and there was poverty everywhere. And you go, wow, yeah, it doesn't make sense to invest when things look like that in America. Well, from 1932 through 1936, here's what happens. Large US stocks up, small companies way up. It was a really bad idea to pull people out of stocks when it really got down to it. Has the media improved? I mean, we look, back through time and we look at some of these magazines and headlines and go, well, how did they do? Business Week said the death of equities, that inflation was destroying the stock market. What do we keep hearing about right now? Inflation, inflation, inflation. It's the worst thing it's been since in 40 years and blah, blah, blah. And they said that same thing in 1979. They said the death of equities, inflation's destroying the stock market. And they said, pensions pulling money out of stocks. They're going into other things like commodities like gold and diamonds, and older investors are yanking their money, or older investors, no one's sticking with stocks, Younger investors are yanking their money from stock markets. And Wall Street just learned that there were more profitable things besides stocks to sell. And that's what Wall Street is all about. What will you buy? Will you buy an annuity? Oh, okay, we'll market an annuity to you. Will you buy gold? Will you buy silver? Will you buy cryptocurrency? Well, what will you buy? That's what we'll sell you. And that's what they did back then too. They said, gold, look at what it's done. Stamps and diamonds and farmland and stocks. Oh, stocks are terrible. You just need to stay away from it. It's the death of equities. And Howard Ruff came out with a best-selling book, How to Prosper During the Coming Bad Years. Buy gold, buy commodities. You would have done better reading War and Peace when it got down to it, because here's what basically happened. When they said gold was going to go to 2,000 an ounce, literally it did, but it took 38 years. And this is what gold did since then versus large value, small and small value stocks. And it was with a lot of volatility as well. Then they have headlines like this. Is there a future for individual investors in America's stock market? Fortune, 1982, they're saying this. Is there a future? Well, they created a lot of doubt and there was a future. for stocks. There wasn't much of a future for gold, but there was a good future for stocks if you looked at it, how the 80s turned out. Then you had Japan. They're going to take over the world. Well, now they talk about China taking over the world. And Japan, the stock market dropped 63%, really bad. Now, they also had articles back in the 1990s about how recession was developing and how it was going to affect the stock market. And you think, wow, recession? Where are you hearing that? You're hearing that all over the place right now, aren't you? Well, here's what happened when they said recession may be developing. Over the next 12 months, stocks went up 33%, large companies, small companies up 56%. So don't necessarily think just because there's a recession, that means stocks will go down. Remember, companies can control their costs too, and that can make stocks go up even when the economy is bad. These temptations to time the market are everywhere. And we see it with tech stocks. Remember in tech stocks in 1999, they said the internet was the safest bet around. And the NASDAQ went from 5,000 down to 1,100. Not a good idea. Recession? Oh, it's tracking the Great Depression. They said that in 2009. When you think, wow, depression was really bad. Stocks went down 80%. This recession's tracking that. That's terrible. And you look at what happened after that article came out. Actually, stocks went up significantly. Again, it was a false pattern. Then smart money said, hey, Americans are too nervous to invest. They've stored $600 billion in cash with their brokers. And the broker said, well, just, Mr. Jones, just sit in the sideline right here. And we'll just kind of, when things look better, we'll get you back in the market. Well, the problem was that when the market went up, it went up fast and furious. Over the next 9 months, I guess you'd say right here, the stock market went up about 68% if you were diversified versus cash only going up 0.1%. And a lot of investors missed out on most of that return because of this kind of stuff. New York Stock Exchange CEO, this real money investors sat out the market in March, and they're waiting for another rally around June or July. So we're just kind of watching the market. Well, the problem is when you watch, lots of things happen. In March of 2009, they said that they were kind of sitting out this rally. So they missed a 9% return in large companies and 11% return in small. Well, they also missed April if they're waiting for June to come along. They missed 9%, 24% return, and they missed May as well. You look at that, they missed a lot of return just sitting there waiting for June to come around. And if we look at Market Watch here, 1, 2, 3 punch could drop stocks 30% in 2016. They said energy sector was in decline. World economy is experiencing violent currency swings. Bank stocks are in a bear market. Things were looking bad, but that didn't stop stocks from actually going up. And it was just the opposite of what they said would happen. So realize that headlines depend on market conditions. After you get these market downturns, you'll hear all kinds of negative, terrible, scary, nasty news on how things are going to get worse. After markets go up, you will hear all the great stuff about how you can get rich and double your money and why you should be optimistic. Too little, too late. Now, there was a University of Michigan study. A lot of times people sit there and go, well, I'm going to wait till things get better, and then I'm going to get, into the market. And this study, what they did is they found that 96% of market gains from 1963 to 2004 occurred in just 0.9% of trading days. Now, to use more modern numbers, 2000 to 2019, you look at this 20-year period, large U.S. stocks went up, 100,000 grew to $324,000 in the S&P 500. If you just missed the best 5 days, you're only looking at 214,000. A huge difference by just missing 5 days. If you look at it another way, using a little bit different data here, $10,000 actually invested from April of 1997 through March of 2017, you have 5,040 trading days. If you took out the top 30 days, stocks actually drop in value. They didn't make money. And treasury bills actually went up a little bit over that time, but Stocks, you look at that and go, oh my goodness, terrible. 0.6% of trading days occurred for all of the positive growth. That's 2.2 days per year. Unbelievably fast. When markets move, you can't get in on time. And we're not given any clues as to what those are going to be, and the pros don't know either. Charles Ellis, actually an academic that teaches investing, says the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. It doesn't work. Now, what if you're that older person that says, I don't have forever? If you're a young person, yeah, you can be mainly in stocks because stocks protect against inflation. What is inflation? Prices going up. Who's raising prices? Companies. What do I own when I own stocks? I own the entities that are raising prices. If you've got a car selling for $30,000 and all of a sudden the dollar drops in value to half of its purchasing power, the car seller, the company that makes cars, not going to accept $30,000 for their car anymore. They're going to increase it to 60 because the dollar isn't worth as much. So hence what will happen is eventually their earnings will go up. Now, in the short run, when you have inflation, stocks can go down temporarily because companies are a little bit slow to raise prices because they can lose market share and they can lose customers. So they're a little bit slow. They may actually take a hit to profits in the short run. But in the long run, they're going to raise prices to survive. Now, what do you do as an investor? You start to add some bonds to the portfolio for shorter time horizons. So when you're in retirement and you're taking an income, you might be 50 to 60% stocks. You might have 40 to 50% in bonds and short-term investments and more safe investments to buy time for when stock markets recover from their downturns. So it is typically, you'll hear me say that to investors. You might be all in cash if you need all of your money back in a couple of years. But if you need the money to last a longer period of time and protect you from inflation, and let's face it, even if you're 75, you might have an 11-year or 15-year life expectancy. You might need some protection against inflation. If that's the case, owning equities makes sense, and you don't want to walk away from diversification because that's when you really have risk, is when you walk away from diversification or a standard of investing that has been shown as prudent in every academic study. And we look at the last 70 years, but it's not just the last 70 years. Solomon talked about diversification going back almost 3,000 years. So it's not a new concept by any stretch of the imagination. So hope this helps walking through where some of the data came from in this particular presentation. Investing is simple, but it's not easy because our emotions drive us to take action at some of the absolute worst times. So as an investor, what we want to do is we want to make sure that we keep the emotions in check. And usually the best way to do that is build up the cognitive part of your mind. I always say I plus E is greater than C. Our instincts and our emotions tend to outweigh the cognitive part of our mind. So that's why education is so important, to build that cognitive part of your mind up. Because remembering the Dalbar research, the average investor has gotten really bad returns versus inflation. And you don't want to be that person because it's tough enough in retirement already. Okay, hope you enjoyed this and hope this helped. We'll catch you all next time.